Hello, everyone, and thank you for joining us today. My name is Amy Hollenkamp with USI Insurance Services, and we are thrilled to be partnering with Boulay to bring you this educational event series. This is the second webinar that we've been doing, titled Adapting Your Business to Changing Times. And really our goal is just to bring timely topics to you as business leaders so that you understand what's going on and how that may impact your organization. And so with that, they're 30-minute series. We will send out the recording, following the webinar. And if you have any questions, feel free to put them in the chat box. We'll address those at the end of the event. We've got two fantastic speakers today. The first is Brittany Hancock. She is the Audit Manager at Boulay, and she's going to be discussing the Financial Accounting Standards Board and how it has redefined accounting leases for private and public companies. So with that, Brittany.
All right, thank you, Amy. Excited to be here and sharing a little bit about the new standard and what that means for your companies. So with that, Amy, do you want to progress to the next slide? All right, so for most companies, the previous adoption date was a little bit sooner. With COVID, we kind of got a year lag with that, which is nice because it gives us a little bit more time to evaluate the impacts of that. So for most companies that have a December 31st year end, this standard becomes effective for fiscal 2022. Now that being said, for most companies that have audited or reviewed financials, you want to have evaluated that impact on January 1st of 2022. So that's where it's important to start thinking about those pieces now, because it will have a pretty large change, especially if you have a significant amount of leases. Because previously operating leases were, mostly just a disclosure item as far as the 5-year payment schedule, whereas now all leases are being reported on the company's balance sheets as both assets and liabilities. So with that, we'll go to the next slide. So just to kind of touch on some of the basics of the new lease, really the definition is whether the contract is a lease or contains a lease. And that primarily is whether or not the company has, the right to control the use of that identified property for a period of time. So one of the pieces that comes into play with the new lease standard is what's kind of termed an embedded lease. So for example, say you have a supplier who's providing oxygen as part of an agreement. And part of that agreement includes the storage of, an oxygen tank that is bolted into the ground, cannot feasibly be moved or replaced easily. So the substitution right doesn't really factor in because it's not easily substituted. It's built into your plant, but that asset is owned by your supplier. The new standard requires you to look at whether or not that oxygen tank is part of a lease, is an embedded lease within your oxygen supply agreement. So just kind of a basic example of one of the new changes. So for some of the terminology, we would have seen previously capital and operating leases. The new terms are finance lease and an operating lease. So for example, the finance lease is pretty consistent with what you would have seen for a capital lease. The same criteria as far as what trips the operating versus finance lease still applies. So for example, transfer of title, purchase option, also known as typically a bargain purchase option, if the lease term is over a major part of that remaining economic life of the asset, whether or not the present value exceeds or equals substantially all of the fair market value of that asset. And then the asset specialization, if that asset is so customized that it provides no alternative use to the lessor. So some of the term changes that you're going to see, typically it used to be for the lease term, if it was over 75% of the life of the asset, that now is defined as, the major part, which is not specifically defined in the new standard, but the 75 is what we're seeing most companies still utilize. Same thing with the present value of the lease payments. The new term that they are using is equals or exceeds substantially all of the fair market value of the asset. Again, was not clearly defined what that piece is. So it is a part judgment in looking at that. But we're seeing a lot of companies kind of still utilizing that 90% as the substantially all of that fair market value. So as you can see on this slide, the balance sheet impacts for all assets, you're going to have a right of use asset and a liability. The income statement impact is slightly different depending on whether or not it's a finance lease or an operating lease. So if it doesn't contain one of the 5 criteria, then it would be an operating lease. And then the cash flow impact is just slightly different. So moving on to the next slide. So one thing, as you go through contracts, part of the process is identifying if a contract has a lease. So it's normally easier if it's explicitly stated that I'm renting this specific van and here's the value of it. It's tougher when you get into those contracts that have an implicit implied asset. So for example, that oxygen tank, it may not be implicitly or explicitly stated in the agreement, but if a supplier has to use that asset in order to fulfill the obligations to that contract, it would be an implicitly implicitly implied contract. So, in kind of looking through your lease, if the asset is either explicitly or implicitly supplied and is physically distinct, then you do have an identified asset. One piece that comes into play is whether or not that supplier has substitution rates. So for example, in that oxygen tank example, if that supplier does not have the practical ability to substitute that asset, then there is no identified asset. So it is very judgment based. Moving on, one of the pieces that we'll see coming up, and you'll probably have seen it in public company disclosure, is the 3 practical expedients that are elected as of that transition date. And those are not reassessing the lease classifications of leases in existence, not reevaluating embedded leases, and then no reassessment of the initial direct costs. The election of the 3 practical expedients has to be done all at once. They can't be separately elected. And it does reduce some of the time in that transition period. One thing to consider as you're evaluating the impacts of the different leases is if there's a specific lease classification that is preferred for, maybe your company specific EBITDA calculation or other purposes, maybe bank covenants, it's important to take a look at what those practical expedients would mean for your company and your specific needs. So something just to consider as you work through that adoption. One of the other pieces that comes into play is identifying the lease components versus the non-lease components. Sometimes certain contracts can include, training, repairs and maintenance, security or management services, or supplies that's, built into that agreement. And so a leasee can elect to include both the lease and non-lease components as a single component. However, it can substantially increase the asset and the liability that are being recorded on the balance sheet if they are larger than they need to be. So, one thing to consider as you're going through too, do your leases contain non-lease components that need to be factored in for how much value and how that plays into the amount of that asset and liability that gets put on your balance sheet. Just to touch on a few pieces of the lease disclosures that we're seeing, certainly public company examples are a great place to start, since they, as private companies, you've got the benefit of getting to see what everyone else has done. And so, some of the pieces that are coming up that's a little bit different is the weighted average remaining lease term, the discount rate, the accounting policy regarding those short-term leases, information about leases that have not yet commenced. And kind of the breakout between those finance and operating lease costs is all in play as far as lease disclosure. Now, one thing to note on the short-term lease piece of it, if you do have a contract that has a non-cancelable lease term that's less than 12 months, it may not always qualify for that short-term lease exception, for those don't have to be put on your balance sheet. If, say, there's renewal policies, so for a lease, maybe it's 12 months, but you have renewal policies that cover 3 years. If it's reasonably certain that you're going to adopt those 3 years, you may want to consider whether or not that really is a short-term lease or a 4-year lease where you would need to put that on the balance sheet. So all things where, really getting into what the contract says or what that lease agreement says can be very important in how that gets adopted. So a few things we wanted to touch on just from, the challenges from public company adoptions. Amy, if you can progress to the next slide. Big things that we're seeing are high volumes of lease agreements. Information may be contained in multiple lease agreements as well, which, can kind of add to the headache of trying to figure out where the information is contained and plays into the tracking of leases and the amendments as well. One big piece that we're also seeing that can be quite challenging is the determination of that discount rate. So for different leases, if you have a company in Minnesota that's leasing an asset, it may not have the same discount rate as a lease in, say, New York, because you have to consider not only the geographical locations, but for different companies, if you're leasing an asset, you have to consider the collateral. So if you're taking a loan out for a building, that might have a different borrowing rate than borrowing for a vehicle. So all things to take a look at and start talking with your bankers as well. To start looking at what those different discount rates might mean, because that can significantly change, the asset and the liability that gets recorded. Other things that we've seen a lot of companies looking at from just a simplification purpose is purchase versus lease consideration. So as you're looking at, whether or not you want to renew a lease or buy an asset, looking at, are there tax benefits to the bonus depreciation versus leasing the asset? Do you have the cash flow to purchase that? And the other piece that comes into play with the new lease standard is what effect does that have on your bank covenant calculations? Some of those things are good to start talking about early on so that if there's adjustments to the covenants that are needed in order to allow you to still comply with the adoption of the lease standard, all good things to start working on now so that you alleviate some of that headache down the road. So just to talk briefly, because I know we're running out of time here quick, for the post-implementation issues we've seen, obviously lease identification has been a huge topic. And as we kind of touched on, it can be very different on whether or not there is or is not a lease, depending on whether or not it's explicitly or implicitly implied. Other pieces that come into play, the right of use asset is subject to impairment similar to other property, plant, and equipment. So that's something that needs to be considered if there's an impairment triggering event, as well as remeasurement events. If you have an adjustment to that lease agreement that changes the term, payment structure, then you may have to go through the process to remeasure what does that lease asset look like now that we've gone through this remeasurement or this lease amendment. So with that, as always, if there's any questions, we're always more than
Sorry to interrupt, Brittany. There was one question in the chat. Can major repairs be capitalized on leased equipment?
So with that, I believe similar to property, plant, and equipment, if it is not substantially adding to that piece of equipment, so adding a new feature, then repairs and maintenance are typically still expensed. But thank you for that. Certainly if there's any more questions, we're always happy to answer those, you can either reach out to us at Learn More at Boulay Group or to myself. And always happy to talk through. I know we've been working with a few of our clients already in looking at what does the adoption look like? How do we help them track that information? Because as we know, if you've got computers, printers, office lease, truck leases, it can be a lot. And so that's something that we've started to help our clients, our private clients with from a tracking perspective, just to help make life a little easier. So with that, I'll pass it back to Amy.
Thank you, Brittany. That was great information. And our next speaker today is Laura Miller. Laura is our lead employee benefits compliance attorney at USI. And she's going to be speaking today about the Cobra subsidy that has become available under the American Rescue Plan Act. So with that, I'll pass it over to Laura.
Perfect. And we can just go ahead and dive into the presentation, Amy. So as Amy said, my name is Laura Miller. I'm the employee benefits compliance attorney for USI's Mountain Central region, which encompasses the great state of Minnesota. And I'm also joined today by Amy. I know Wade is also listening in. So if you have any questions, and we'll do a Q&A at the end of my speaking part, but any follow-up questions after today's presentation, always feel free to direct those to Amy and Wade. And if need be, they certainly know how to get in touch with me. So with that, I'm sure you have all heard by now that the American Rescue Plan Act, or ARPA, as Amy just described, includes a 100% Cobra subsidy for any period of Cobra coverage from April 1st of 2021 through September 30th of this year. Now, this Cobra subsidy is mandatory. It's not optional for employers to implement. So there have been a number of relief that has been issued by regulators where employers have the option of choosing whether or not to utilize that relief. You may have heard about relief with regards to health FSAs or dependent care FSAs. That relief is optional. This relief, not so optional. So just want to make that distinction, as a couple of clients have raised that question with us. So this means that assistance eligible individuals, or AEIs, as I'll refer to them throughout this presentation, can get possibly up to 6 months of free Cobra coverage. But it's important to note that the subsidy doesn't entitle anyone to more months of Cobra coverage than they would have otherwise been allowed to receive. So in other words, if someone's maximum Cobra coverage period is scheduled to end July of this year, just because there's a Cobra subsidy in place doesn't mean that they get to continue their Cobra coverage through the end of the subsidy period or through September. Their Cobra coverage and the subsidy will end in July. So also want to make that point clear as well. As far as the employers that are impacted by the Cobra subsidy, it's a rather large group. So you have employers that are fully insured or self-funded with at least 20 or more employees. Those are going to be your employers that are subject to federal Cobra requirements. You are going to be included and impacted by this Cobra subsidy. It's also going to include our smaller employers as well that are typically only have to worry about complying with state insurance coverage laws or state continuation coverage. So employers with fully insured group health plans that maybe have fewer than 20 employees, but you're subject to state continuation laws like Minnesota's state continuation coverage, you're included. And then also church employers with fully insured group health plans that again are going to be subject to those state insurance continuation laws comparable to Cobra, you will be covered as well. So quite a large spread there of employer groups that are being covered. Now, again, AEIs, as defined under ARPA, are going to be the individuals that are eligible for this Cobra subsidy. To be considered an AEI, an individual has to be eligible for Cobra or state continuation for those smaller employers due to an involuntary termination of employment or a reduction in hours. And this is also going to include spouses and children who are Cobra eligible as a result of the employee's involuntary termination or reduction in hours. So you're really looking at 3 different types of possible AEIs. First is going to be any new Cobra qualified beneficiaries. So anyone who newly becomes eligible for Cobra due to an involuntary termination or reduction in hours beginning April 1st or today, through the end of September 30th, they're going to be our new Cobra qualified beneficiaries. Then you also have existing Cobra qualified beneficiaries. So let's say that someone was involuntarily terminated. They elected Cobra in January of this year. So their Cobra coverage period, or their 18 months of Cobra, is going to continue into April through September of this year during that subsidy period. Even though their Cobra coverage started before April, they would still be eligible to receive that 6 months of Cobra coverage, just like any new Cobra qualified beneficiaries. And then finally, and probably the most confusing category of employees or individuals that would be eligible for this subsidy are going to be our second chance Cobra qualified beneficiaries. So these are going to be assistance eligible individuals who again had that reduction in hours, termination of employment, that maybe either initially elected Cobra but have subsequently decided to terminate that coverage, or maybe they didn't elect Cobra at all when they had that Cobra qualifying event. Because of the Cobra subsidy, they are now eligible for a second bite at the apple, so to speak, to enroll in Cobra coverage effective April 1st of this year. So their Cobra coverage doesn't even have to be retroed back to their original date of the Cobra qualifying event. They can purely elect it beginning April 1st with that Cobra subsidy. Now, it is important to note that an AEI's maximum Cobra coverage period must overlap with that subsidy period, right? So if you have someone that was eligible for Cobra a couple years ago, they declined, their 18 months of Cobra coverage has already ended. They're not going to be eligible for the Cobra subsidy now that it's available. Their 18 months, have already come and gone. Also, in order to be eligible for the Cobra subsidy, an AEI cannot be eligible for other group health plan coverage or Medicare. So when we think about all of this information and all of these possible AEIs, there's actually probably going to be quite a few folks that even if they were involuntarily terminated or had a reduction in hours, they're not going to, at the end of the day, get that Cobra subsidy because they're eligible for other coverage. And that could be a spouse's employer's plan. If you have a young workforce, it could be that young worker who's still under the age 26 and eligible for their parents' plan. So a lot of different ways that people can become ineligible for other coverage. Also, who's not eligible for the Cobra subsidy, so it's going to be people who voluntarily terminate their employment, dependents who age off the plan. If it's due to divorce or legal separation, that loss of coverage won't count towards the Cobra subsidy. Also, an employee's death, as unfortunate as that is, doesn't qualify for the Cobra subsidy for the surviving spouse and dependent. And then any employees who aren't offered Cobra due to gross misconduct, although be careful with that one because gross misconduct is a very high standard to meet. Think someone who is currently in jail because they've embezzled thousands of dollars from your company, right? But if it's just due to the fact that they failed to show up for work timely, or even that they didn't do their job well, that's not going to be considered gross misconduct under the law. Now, as far as what employers need to do to notify these individuals, there are a number of new model notices that have been provided by the DOL. So you'll want to make sure that you are providing these to your Cobra qualified beneficiaries. So for any of those new Cobra qualified beneficiaries, so anyone who loses coverage between April and September of this year, you're going to use the model general notice and Cobra continuation coverage election notice. Plus, you also need to provide the summary of Cobra premium assistance provisions under ARPA. And it's that last document that really provides a form for employees to complete that they will then provide back to you to let you know that, yes, they believe they're eligible for the Cobra subsidy because, for instance, they don't have any other coverage that they are eligible for. So those documents need to be provided as soon as possible following the loss of coverage, but no later than 44 days. So those traditional Cobra notification rules continue to apply. When you're dealing with an employee that has already enrolled in Cobra coverage prior to April 1st, due to a reduction in hours or involuntary termination, or continuing on the chart in the next page, an employee who has lost coverage between October 1st of 2019 and March 31st of 2020 due to a reduction in hours or involuntary termination, you're again going to provide that model notice in connection with an extended election period, because again, these are existing Cobra qualified beneficiaries or our second chance individuals. So they get the extended election period notice, plus again, that summary of Cobra premium assistance, so they can notify you whether or not they are eligible for that coverage. And the deadline for providing that is May 31st of 2021, so the end of this month. And then lastly, for any of those employees that lose the Cobra subsidy, either due to the end of the Cobra subsidy, so as we approach the end of September, or maybe sometime between now and then because their maximum Cobra coverage period has ended, or they're notifying you that they are now eligible for other coverage. Maybe they got another employment opportunity, and so they have coverage through that employer. Then you need to provide the model notice of expiration of premium assistance, essentially notifying them that that free Cobra coverage is ending. And this has to be provided no more than 45 days, but no less than 50 days prior to that loss of the subsidy. So for anyone who is losing the subsidy because of the end of the Cobra subsidy period at the end of September, you'll need to provide that notice between August 16th and September 15th to notify them of that loss. Now, a few other reminders, just, how are the Cobra premiums subsidized? They are subsidized by the federal government through Medicare payroll tax credits. We are still waiting for additional guidance with regards to how exactly this is going to work. So be on the lookout once that guidance is issued. I know for any USI clients and prospects, we'll be sending out alerts on that. I'm sure there will be many other alerts out there from other organizations as well. But just know that it will be subsidized by the federal government through a Medicare payroll tax credit. So what exactly are the next steps with regards to the Cobra subsidy? You'll want to make sure that you discuss this with your Cobra vendor if you have one, including their ability to provide the new notices and update any election notices for new qualifying events. Make sure that you identify all of those potential AEIs, including those second chance individuals, get the proper notices to them. Then also you can determine whether or not you want to allow AEIs to change their coverage. So there is an option where employers, if you so choose, can allow these individuals to choose a lower cost plan. So if I'm enrolled in a higher cost PPO plan, I elect Cobra and I want to switch to a lower cost plan for my Cobra coverage. Normally that wouldn't be permissible unless it was an open enrollment opportunity, but now you are allowed to do that through these regulations. Because it's free Cobra coverage, I don't know that many employees would actually want to elect a lower coverage because they're not paying for it anyway, but it is an option that is out there if you so choose. Just make sure that your carrier is also okay with offering that option. And then of course, just discuss those payroll tax credits or Medicare tax credits with your payroll department, especially once that guidance is issued. Make sure you have it set up to receive those credits. So with that, I too thank you for your time today. I know you've got Wade and Amy's information listed there on the presentation if you do have any follow-up questions after today's call.
Thank you so much, Laura. Very great overview, and thank you, Brittany, as well. We hope you found this helpful. We will be sending out the recorded presentation as well to all of the registered attendees. I don't think I noticed any specific questions in the chat box, but like Laura said, feel free to reach out to us directly if we can help in any way. And appreciate your time today. Hope to see you at the next event. Take care. Bye-bye.